In a week that's going to be dominated by the US election, it's quite easy to forget the fact that we have a Bank of England interest rate decision on Thursday, the 7th of November. Nonetheless, we're expecting to see a 25 basis point cut. But coming off the back of a UK budget, this is going to be a particularly interesting one as people try to gauge exactly what the pathway is and the outlook is from the Bank of England, given the potential repercussions of that budget on inflation expectations. So let's get into it. So a number of slides to take you through. On the first one, we're talking about inflation. So the downward trajectory of inflation does continue, and this provides the potential basis for the Bank of England to be able to act. I mean, look, ultimately, the Bank of England would love to be able to enact 50 basis point cuts at each turn. But you need to know whether the economy is in good shape. You need to know whether inflation's essentially tamed. You can see here CPI 1.7, that has been tamed. But the core figure at 3.2 is still pretty elevated. And you can see it here in terms of the breakdown for that core metric, 3.2 on the core figure. And the question mark is, when are we going to see that return to anywhere near target? And it's not going to happen in the near future. It's going to happen next year because you can see here that December, yes, we can see some disinflation because you've got a monthly figure of what looks like about 0.6. So we see some disinflation then. There's a good chance that we do get back around that 3% mark. But then you see that massive January figure, that negative January figure. That's going to see a big bump back towards the upside in all likeliness. And so the disinflation is really going to come when we see February stripped out, March, April, May. So it could be towards the back end of Q2 that we actually see that core inflation metric around target. So you can see that there's going to be some hesitancy on that front. Crucially, we did see at the latest UK inflation report that services inflation actually came in lower than expected. You can see here, services CPI 4.94 as the current metric. And that really has provided the uplift and the upward trajectory for, in particular, that core reading. So, of course, you can have, downside moves for energy prices and food, for example. But services do provide a massive chunk of the UK economy. And it is really the key determinant as to why we're seeing elevated core inflation, goods inflation, the drag, services inflation, lifting the overall metric, and certainly that plays out more heavily within the core figure. You can see in terms of wages, they have been on a downward trajectory. This is for the services sector in particular. So what we're seeing here is downside moves in terms of services inflation and the earnings within the services sector. That does provide the basis for expectations that we will see continued weakness. So that is a good thing. Certainly we'll be looking up for any commentary from the BoE as to whether they think this is indicative of a new sort of trajectory in terms of services inflation, because it did come in below expectations. But nonetheless, I mean, look, there's a good chance they're probably going to be coming off the back of, say, the UK budget, coming off the back of the US election, and they're likely to take on a relatively cautious tone for that. The UK budget is going to be a key part of this, and certainly there's been a big story about this surge in terms of UK Treasury yields around the budget, the rise in terms of borrowing costs, and saying, well, they've come out with such drastic measures that ultimately the benefits of what they've done have been eroded by the rise in terms of borrowing costs. So the fiscal headroom's already being eroded soon after that announcement. I put US 10-year at the bottom there. These are all UK yields. So the 1, the 5, the 10, all moving towards the upside. It's not the same as when we saw Liz Truss in. She enacted measures that saw a massive surge in terms of Treasury yields, well over and above what we saw in the UK. And crucially, what we saw in the UK, as you can see here, is part of a trend that had been playing out over September and coming into the budget. It wasn't only a response to that budget announcement, and it's something that we've been seeing elsewhere. Largely, it was driven by a move over the course of the past month and a bit in the US, where we saw a surge in terms of US Treasury yields coming into the election, and also the fact that we saw that stronger jobs report number, payrolls figure out of the US. Suddenly we went from, we're going to see 50 basis points at each meeting this year, to maybe we'll just see 25 at each. And that did lift the US Treasury yields. And with that, you see competition for demand for some of these other assets, some of these other notes. And so we saw many of the other yields go with it. And you can see that exactly here. This is a really important chart. What you can see here in the green line is the US divided by the UK 10-year yield. And what you can see is that the US has actually outperformed, or the rise in terms of yields over in the US has been over and above the UK. You can see after that budget, we did see a bit of a move towards a downside where the UK yield rose by a greater amount. But by and large, you could say, well, the UK yields are on the rise, and you can link that to the budget. But in actual fact, it's been a move that has been playing out across many of the other markets as well. And it's been playing out over in the US. And especially around that time, we've actually seen the US yields rising more so than the UK as we head towards the US election, with the prospect of both candidates essentially ramping up spending, increased borrowing, and therefore they're going to have to issue more debt. So certainly it feels like the demand for this debt is questionable at the moment. And the UK is talking about funding all sorts of spending. The US is going to be doing the same kind of thing. So they're competing on the yield front. But certainly you see here, overlaid with cable, the upside move that we've seen in US versus UK treasuries could point towards an upside move coming into play here for cable. And that's something we'll look at in a sec. Notably, the strength of the pound comes with the expectation that the UK bank, was Bank of England, central bank, is going to cut by a lower amount than many of its peers. You can see here the Bank of England over the course of the past month, those expectations have been reined in quite significantly. That has also happened for the likes of the Federal Reserve and the ECB. But more so for the Bank of England with a relatively cautious tone. Part of that could come down to inflation expectations, and part of that could also be in line with the budget. But certainly that shift and that lower expectations from the Bank of England should provide the basis for outperformance for the pound. In terms of expectations for this meeting, 95% expectation of a 25 basis point cut. You look beyond that, and in December, markets expecting that we see a pause. So this very cautious approach, there's going to be question marks as to whether that will or will not play out. And certainly if we see this sort of slow and steady, every other meeting kind of approach from the Bank of England, that's something that's likely to provide the basis for potential strength for the pound going forward. And certainly that would be relevant for the likes of euro sterling. Let's just bring up euro sterling here. First and foremost, you can see that we've been seeing a bit of a pop recently. Let's just bring it up on a bigger time frame. So we've seen a bit of a pop recently, but you can see a very clearly defined downtrend here for the euro against the pound. That pop already being sold into. So if we do see some upside, I think it's likely to be fleeting, but there's a good chance that we don't necessarily see that. And certainly if we see the Bank of England taking on this very cautious approach, we'll wait and see. You know, it's going to be slow and steady, and it continues to make people believe that they're going to be cutting every other meeting, then we could see euro sterling roll over once again with that sterling strength. But like we were talking about previously, sort of overlaying the UK and US yields against cable, let's just bring that chart back into play. So we've got this very clear uptrend. We've seen this rebound that's played out for the yields that hasn't necessarily played out thus far for cable. Of course, we've got the US election. As I record this, people are still voting. So we will, of course, see how that plays out. And that's going to have a significant impact on the US dollar. But I think there's a good chance that what we've been seeing in terms of this so-called Trump trade, in terms of strength of the US dollar, a lot of that's in line with, yes, there's potential inflation expectations, higher inflation expectations in line with Trump. So people could say it's a Trump trade thing. Part of it, I think, is heavily to do with that shift that we saw away from the potential 100 basis point cut in the two meetings that are left this year and towards a 50 basis point cut. That recalibration that's taken place over the course of the past month has provided the basis for some of these moves. Now, so what we've seen here is this upside move for US versus UK 10-year yields. And then we haven't necessarily seen that coming into fruition for cable. And so once we see things shake out, I wouldn't be surprised to see the bulls come back into play for cable. And we can see exactly that here, right? So weekly time frame, very clearly defined bullish trend. We've been seeing this pair selling off for 1, 2, 3, 4, 5 weeks in a row into the 76.4 Fibonacci level. And absolutely perfectly, I mean, it's absolutely textbook stuff here, rebounding and coming up into your first swing high. That swing high is this level here, 1304. If we break through that level, then this intraday trend of lower highs and lower lows is over, and we would be looking for the bulls to be back into a more positive footing. Of course, the US election is going to have a lot to do with this, but generally US elections, unless we see on this occasion we Democrat full sweep, which is the least likely expectation according to places that I've seen it. Unless that happens, I think once the dust settles, markets will be in a positive footing once again. And generally, strong markets don't necessarily go hand in hand with a stronger dollar. So we could still see a move towards the upside for this, even if it was, say, Trump that comes into power. I know everyone says that Trump is a dollar strength story. I think there's still a good chance that even once the dust settles and if we see that the equity markets moving towards the upside, we might still be able to see this market moving towards the upside. But I think it's key here. We've got a very clearly defined uptrend. We've rebounded off the 76.4 fib. We've rallied up into your first swing high. If we break through that level, I think there's a good chance that we do see the bulls in charge once again following 5 weeks of downside for the pound against the US dollar. Here is the chart for the FTSE 100. Crucially, if I overlay cable on that, you can see that generally we see this correlation between the two that should mean if we see a rebound in terms of cable, then we're seeing that sort of dollar weakness story playing out. So a risk on move within markets and the possibility of the bulls to come back into play for the FTSE 100. As things stand, there's certainly still some concern and some risk because we've broken through this structural support area, which is around just sort of 71.75 area. We've sold off, rebounded back in towards that kind of area in the middle of this. It looks like a sort of 50% retracement to me. Let's just grab that. It says 61.8. Is it 50? It is a 61.8. So it's coming to a 61.8, and now we're starting to roll over, breaking down through that first support level here. So there's certainly still some risks here for the FTSE 100, in part due to the hesitancy that we're seeing within equity markets as a whole because of what's happening in terms of the election and all that uncertainty. But, you know, we're in and around this area of support. We're in a sort of wider range here. So whilst we could sell off in a meaningful manner, if we do see cable turning towards the upside, possibility we could see some strength from here. But I wouldn't necessarily say that the FTSE 100 is my go-to market for me to be looking to trade if I was looking to go long equities. In actual fact, what generally happens is when markets sell off, the FTSE 100 outperforms. It just falls by less than the rest. But when markets are in sort of rippy mode, when they're pushing sharply higher, FTSE 100 often lags. So it's, you know, it's useful at certain times, but at other times it can be frustrating when you are long, say, equity markets, but you're long the FTSE 100 and the other markets are outperforming that, as can often happen. So that's worth noting. But certainly this rally into the 61.8, that long upper shadow, does highlight the possibility of some near-term downside for the FTSE 100. Like I said, this is a really interesting report, notably coming off the back of this UK budget. So the outlook from the bank in terms of inflation expectations, whether they've been adjusted in line with this new spending package and new borrowing from the Labour Party. That's going to be really interesting for us to be able to watch out for. But certainly as things stand, markets have quite low expectations in terms of the sheer amount of easing we're going to see over the course of the next year. And that's driven by the fact that we're looking at a potential cut every other meeting. So relatively slow downward trajectory. Will the Bank of England want to ramp that up? Well, it might come down to inflation. And like I said, there's a good chance we're only going to see inflation moving sharply lower towards sort of Q2, I would say, of next year. So perhaps some hesitancy and so-called data dependency from the Bank of England before then.